If you're thinking about buying a property this year, whether it's a home or an investment property, or if you've already got some investment properties, today's show is going to be very important for you because we're going to uncover what really makes a difference over the long term in a property's performance. And it's probably not what you think. My special guest, Stuart Wemyss, has done a whole lot of research, which we're going to unpack. And at the end of it, you're going to have crystal clarity on the property strategy that you must use if you want to get above the pack and develop a level of financial freedom. See, the problem at the moment with our flatter property markets is people are looking for the next hotspot. They're looking for the regional areas because all of a sudden there's a little bit of growth there when there isn't in the main capital cities or the outer suburbs or the inner suburbs. Too much confusion. The statistics, the figures are in. It's very clear. So we're going to explain it all to you. So welcome to this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted our leading expert in wealth creation. That's the fifth time he's won a similar award in the last 7 years.
Are you considering buying an investment property? Now, if you are, you're probably wondering, should I wait now? Should I buy now? Should I wait and property prices go to fall a bit further? Maybe I should hold off. Now, maybe a better question would be, how important is it to get the timing right? And really, what are the most important factors in the long-term performance of your investment property? Well, that's exactly what I'm going to discuss with my guest today, Stuart Wemyss, Director of Pro Solutions Private Clients. Now, he's done some very interesting research that makes the picture crystal clear for you. Hello, Stuart.
Hi, Michael. Great to be with you again.
Thank you. Well, I know our podcast last year, we did 2 in a row about your great book, Investopoly, were amongst the most popular podcasts we did in 2018. So I'd recommend listeners go back and do a search and listen to those, because we went through your golden rules of property. And if we've got time, I'd love to talk about those again. But Stuart, I know a number of years ago, you did some very detailed research on the importance of timing the property market purchases. How important is it? And you went back quite a number of years and you looked at the Sydney and Melbourne market. But more recently on your blog on prosolutions.com.au, you detailed some further research. You looked at the various elements that affect a property performance and you looked at the impact of them. Now, because it was so good, I wanted to link to that in the show notes, because your findings really got some very clear implications on how one should be investing. And the most important factor driving property investment success, after reading your research, is indisputable. But I want to hold our listeners in a little bit of suspense for a moment. Now, clearly there are a number of factors involved determining the performance of any particular investment property. So maybe we could just start discussing the various factors that you measured, the assumptions that you made, and then let's get on to how each of these factors affects a property's performance, Stuart. So maybe we can start with what did you look at and why did you go to the trouble of doing this?
Yeah, sure, Michael. Well, I guess I went through the trouble because of obviously the property market has been rather sort of soft, I guess, over the last 12 to 18 months. And it sort of made me think about, well, to take a contrarian view, everyone's kind of a bit anti-property at the moment, or, there's certainly a lot of people predicting, the market's going to fall further and so forth. And there's always, as Warren Buffett says, forecasters will fill your ears but never your pockets. So there's always lots of opinions out there. But I thought, well, if you're going to be contrarian, maybe now's a fantastic time to buy. And how important is it? So what I did is built a financial model, and I picked 7 of the most important variables. And what I did is then tried to ascertain a reasonable range within those variables. And so obviously, with variables like capital growth, you could have massive negative capital growth, or you could have substantial capital growth, but some of those are unreasonable. What's the kind of reasonable range that we can expect? And
Now,
then,
Stuart, if I could interrupt for a sec, I think this is really important because people sometimes don't realize all the variables involved in the long-term success of a property's performance. So can we firstly go through the various variables you looked at? Because I think it's just a really good reminder of what does affect the performance of a property.
yeah, sure. So the 7 variables were capital growth rate. So obviously, on average, over a period of time, what is the appreciation of the property's value? The second one was buying above or under fair market value, and I think that's one that's probably attracts a lot of attention from property buyers. Everyone likes a bargain. The third one was capital gains tax. Now, in this model, I assumed that we went and bought a property, held it for 20 years, and then sold it and walked away with the cash. Now, obviously, in people's strategy, maybe divesting or selling of the property may or may not be appropriate, but anyway, capital gains tax. The fourth one was interest rates. Obviously, if we're going to borrow to buy the property, which I assume we borrow the full cost, what will the interest rate be over the on average over the time of holding the property? The fifth was rental yield, which is obviously a percentage of of the asset's value expressed as an income, the amount of income. The sixth, which I think the sixth one is kind of an interesting one. I'd be very interested in your opinion, Michael. Was the growth in the rental income. So if we go and buy a property today on a 3% rental yield, and it's a high growth property, do we expect that we're going to get 3% for the full 20-year period, or will there be a bit of rental yield compression? So that sort of building that into the model. And we all know as investors, when we get a property, it's sometimes, and you have a long-term tenant, it's sometimes very difficult to always keep the property at market level. You try and increase rent, but it doesn't always can't always do it effectively. And the seventh, which is really a topical one at the moment, was negative gearing. What sort of tax benefits will I get from holding the property?
Now, this is really interesting because I knew we were going to have this chat. So I just asked a random group of people over the last week, and not necessarily seasoned investors. In fact, a few of them were real estate agents. What is the most important factor? What makes a good property investment? And interestingly, a couple of estate agents I spoke to, their thought was buying well, buying cheaply. They got it totally wrong. And others actually mentioned timing in the market. It's really interesting that the sophisticated investors have always known this, but the average person doesn't know. And I hope you're going to teach our listeners what is the most important factor. So the assumption was you put these into a spreadsheet. You said, I bought a property for $700,000. I'm going to hold it for 20 years, sell it, whether you choose to or not. It's still a good way of understanding what the end result is then. And then you only changed one variable at a time to understand how just changing one and keeping all the others constant would affect the equation. Is that correct?
Yep, spot on. And so I determined a reasonable range for each variable. And when I changed one variable, I went to the low end of that range and the high end of that range to see how sensitive the results were based on the change in that variable.
Now, that's the right way to do it. Sometimes you and I do even fancier figures like internal rates of return, bringing it back to today's dollar value. But if you really want to compare one investment against another, that's the way you've got to do it. Put in all the cash flows in, all the cash flows out, capital growth over time, and then what tax you pay and what you're left with in your pocket. So having done all that, now let's take our listeners out of their suspense. What's the answer, Stuart?
Okay, so let's cut to the chase then. Of all those 7 variables, which is the most important? By far and large, and anecdotally, I say 60% of the return is delivered by capital growth or determined by the capital growth.
Please repeat that again, Stuart.
So 60%, so almost, by far a significant proportion is by capital growth alone. So it's really about the quality of the asset, and it's really about, if I go and buy this asset today, what will it be worth in 20 years' time? Not 2 years' time. Who cares what it's worth in 2 years' time? what is it going to be worth in 20 years' time in this analysis, or 30, or whatever your time horizon is. And that's really almost, I would say, that's the only thing that you need to focus on.
So the concept about timing it right, maybe I'm going to miss out. There's fear of, before was fear of missing out. Now it's the fear of buying early. How important is that? How much factor does that take? How much does that affect it?
I would say not important at all. Zero.
Now, if we look at those figures, I may actually lose 10, 20, 30, $40,000 by buying now and the property drops a bit before it goes up. But in 20 years' time, my $700,000 property will have doubled and probably doubled again. And 20, 30, 40,000 out of a $2 million property, the end result doesn't really matter much, does it?
On paper and in reality, absolutely not. And the only thing that's driving us to buy well is really ego. We don't want to look like an idiot and buy at the peak of the market, and then the market falls, and then our property value falls, and we feel like a bit of a dill because we could have waited until the bottom of the market and purchased then. But firstly, it's a flawed assumption. No one really knows where the bottom of the market is. And no one's developed any sort of reliable indicators to consistently predict where the bottom of the market is. So it's impossible to do that. Really, we're long-term investors. So particularly with property, given the transactional costs. So what we want to do is just buy the right asset. And if we pay a little bit more, or we buy at the top of the market, in the fullness of time, it will be completely immaterial. It's really just ego that's driving that desire to buy well.
And I was excited to see your statistics about what would happen if capital gains tax or negative gearing was changed. So there is a likelihood of that occurring, and it will scare some people. But if you do the numbers and figures, yes, it will affect your cash flow along the way, and it will affect how much you end up in your pocket in 20 years' time. But nowhere near as important as the correct asset selection. So putting all this together, what should this mean to an investor's property strategy?
Okay, so if 60% is determined by quality, so capital growth rate, 20% of your return is delivered by the capital gains tax that you pay. As you can imagine, if you pay nothing or a lot of capital gains tax, that's going to make a big difference. Then 10% by your rental yield and 10% by your interest rate. So let's assume that actually you're not going to sell the property, or your plan doesn't include divesting of the property. What that means then is really the quality or capital growth rate is probably 80% of your overall return. So instead of trying to chase 2 or 3 or 4 different rabbits and risk catching none of them, my advice to investors, particularly because obviously the capital growth rate will really be determined when you actually buy the property. That's really asset selection. So my advice to investors would then forget everything else and just get the one thing right. Who cares about anything else? Just get the asset selection right, and you'll do well. You can get everything wrong, but you get the right property, you'll make money. If you don't get the right property, there's nothing you can do to recover from that.
Well, that's interesting. That's a really good point, because I know you see clients in the various capacities as a finance strategist, as a financial planner, as an accountant. You wear a number of hats, and we've both seen people who've actually never recovered from that big property mistake. So does this actually answer the argument of which is better, capital growth or cash flow investment, Stuart?
Oh, without a doubt. Because obviously I looked at a low growth or mid-range growth property at a high rental yield, and from a numbers perspective, and at the end of the day, the amount of money in your pocket, capital growth smashed it, like totally smashed it out of the ballpark. But what my analysis suggests is go and buy yourself the best property you can afford to put your hands on. But then once you've got that property, focus on the rental yield. So do whatever you need to do to that property, whether it's cosmetic improvements, better property management, being a bit more proactive with respect to making sure that property generates as much cash flow as possible. It doesn't matter that it's less than whatever other opportunities are out there in the marketplace. The first step is buying the right property. Then once you've got that property, really focus on your portfolio. And the two things, obviously, as I said, try and maximize the rental yield and minimize the holding costs, which are interest rates, and hopefully you can work with a mortgage broker to do that.
Now, clearly, cash flow keeps you in the game. So you've got to get to the end. You've got to get to the 20 years. So having the right financial buffers, having the right finance strategy makes a lot of difference. Now, Stuart, what you've concluded really fits in with some of the golden rules in your last book, Investopoly. So I'd like to come back after the short break, and could we just talk about a couple of those rules to see how all that fits in?
Absolutely.
Great. Well, I hope you've enjoyed the first part of my chat with Stuart Wemyss, and we're going to be back in just a moment. First of all, I want to give you this week's Mindset Moment because I know they're so very popular. I get that feedback in the regular reviews. And then we're going to have a further chat with Stuart, just unpacking some of his great golden rules from his book Investopoly. But if you've been listening to my podcast for a while, and now even just listening to it today, you're going to realise that attaining financial freedom, attaining wealth, doesn't just happen. It's part of a well-executed plan. And you'd also know that most property investors fail. They just never get the sort of portfolio that they need to get financial freedom. And that's why each week I try and share with you some elements of the strategic approach I use, and we're unpacking that with Stuart today. And that's also the strategic approach the team at Metropole use when they put together a strategy plan for our clients. By giving them a plan, simply, it gives them more clarity. It helps them achieve the financial freedom that our clients deserve. Now, look, you're probably aware that at Metropole, we help our clients grow, protect and pass on our wealth. We've got our buyers agency division that buys properties because we've got our on-ground team in Melbourne, Sydney and Brisbane. We've got property management division, property renovations development, and Ken Race runs wealth advisory and financial planning. But what you may not know is that most of our clients' journey begins by allowing us to build a detailed, personalised, strategic property plan for them. So whether you're a beginner and you want to just start off with a time-tested strategy, and it's going to use a lot of the things that Stuart and I have been talking about already today, or if you're an established investor and you're stuck, or maybe you just want a second opinion about your current situation, why not allow the team at Metropole to build you a strategic portfolio plan? And that's going to give you the clarity on what's possible, but also on what's realistic. Wouldn't it be worthwhile if we were able to show you what you need to do, what the next steps are step by step, how many properties you're going to require, how much cash flow you need, what option A would be compared to option B? Wouldn't it be worthwhile if you knew what your timelines were? So why not go to metropole.com.au, leave us your details, and allow our award-winning team to help you get some clarity in these uncertain times. Metropole.com.au. And remember, we've got no properties for sale. So what we're going to do is sit down with you and discuss your individual needs, and our unbiased property strategists will help you formulate a plan or review your existing property portfolio.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Before I get back to my chat with Stuart Wemyss, I want to share with you a couple of quotes from Albert Einstein. Now, he's well known for his theory of relativity and his Nobel Prize and his contribution to science, but he was also quite a spiritual, open-minded person. And here are some of my favourite quotes that I've read from him. He said, "Everybody's a genius, but if you judge a fish by its ability to climb a tree, it'll live its whole life believing it's stupid." What I guess it shows is that the standardised tests and the exams you get at school and those other assessments of how we are weigh each person on the same scale. Yet we're all wonderfully different. We're all unique, and we really shouldn't be measured with the same metrics, should we? Another quote of Albert Einstein's is, "If you want your children to be intelligent, read them fairy tales. And if you want them to be really intelligent, read them more fairy tales." I guess Einstein was a huge supporter of imagination. He believed it was more important than knowledge alone. He also said, "I have no specific talents. I am only passionately curious." I've found that the average person wants to be told what to do and not worry about figuring things out themselves. Those who are people of value, highly successful people, live interesting lives being curious and fearless of the possibilities. Einstein also said, "The world as we've created it is a process of our thinking. It can't be changed without changing our thinking. Well, that goes along with a lot of the messages you're getting from my mentorship sessions, that for things to come out differently, you have to do things differently. The way you feel about things affects the way you behave and act, and it measures the success and the results you get. So you can't change a problem that you've got with the same level of thinking you have today. That's why a lot of people join my mentorship program and over a year develop a different way of thinking. Interestingly, Albert Einstein also said, once we accept our limits, we go beyond them. So the first step is always to be true to yourself, a closer look at yourself, and then you can go further. Einstein's also said there are only two ways to live your life. One is as though nothing is a miracle, and the other is as though everything is a miracle. Now that's pretty profound, isn't it? Just look at the simple things. We take them for granted. How do you feel about where you are today? What you really should be doing is having gratitude for where you are, and then you'll be truly wealthy. And the last quote from Albert Einstein I'd like to leave you with is, two things are infinite: the universe and human stupidity. And I'm not sure about the universe. Interesting thinking, Albert Einstein. So we learned a few minutes ago, Stuart, that capital growth is king, and that's the most important factor in the long-term performance of your investment property. Now, you wrote a great book. It was your third book, is that correct?
Yes, correct. Yep.
Investopoly. Even though you write so many blogs and you write for The Australian, you're well regarded, that I guess you write a book a year anyway with all your blogs. But there were a number of rules that we discussed last year when we met in my podcast, and I'd like to pull them out again because from what I can see, you just confirmed them all over again. And one of the rules was play the long game, Stuart.
Yeah, and I think it's in this environment, it really highlights the benefit of playing the long game, because the problem with not playing the long game is you play the short game, and then therefore you'll be distracted and influenced by all the short-term noise that's out there in the marketplace. And as my analysis shows, that it really doesn't matter whether we buy at the peak, if we buy today and the market drops another 10%, assuming we've got the right asset, it's completely meaningless. It's going to make any difference to our investment. So therefore, playing the short game will distract you and make you focus on things that really don't matter, create a lot of anxiety, and make it very difficult to make investment decisions. Whereas if I just drown out all that noise and just focus on and say, okay, I want to buy a property that in 20 years' time, it's going to be worth considerably more than it is today, and that's all I'm focused on, then you're not going to really listen to will the RBA cut rates or what a bank economist thinks that the property market's going to do.
No doubt about that. In fact, we know that wealth is the transfer of money from the impatient to the patient, another Warren Buffett quote. And this concept of delayed gratification. Another one of your rules that we both advise our clients on is grow your asset base first and then tilt towards income. I don't know what the rules are going to be about superannuation in the future or negative gearing or capital gain tax. What I do know, Stuart, is that if you have a big asset base, you've got a choice, and you may sell some properties and put them into more income producing assets, shares, managed funds, whatever. But if you don't have an asset base, you actually don't have a choice.
Spot on. If someone walks into my office with an asset base of $500,000 and wants to fund the next 40 years of retirement, I'm not a magician. There's not enough money. It's not going to work. But if someone walks in with an asset base, whether they're great quality assets or poor quality or just all cash, of $4 million, for example, well, that's going to be an easy strategy to design for them to fund the next 40 years of their existence. So it all comes down to asset base. Well, at least first and foremost it does. And then once you've accumulated an asset base, certainly then start thinking about, okay, how do I transition to retirement? How do I need to change the way I'm investing and the asset classes and so forth? But really, before you get there, don't be distracted by those outcomes. It's really about building your asset base. And the best way to build your asset base is to invest in assets that provide most of their return in capital growth and a lot less of their return in income. So you want the overall return still to be, adequate, but it's the makeup of the overall return. So if you look at the Australian stock market over the last 30 years or so, the total return's about 10%, which is made up of about 4.5% in dividend yield and then 5.5% growth. So almost 50-50 income and capital growth. Whereas if you look at the property market, particularly in blue chip areas, the return is still about 10%, circa 10%. But the growth rate's about 8% and the rental yield's about 2%. So still the same overall return. So you'd compare shares and property and go, well, there's not much difference there. But actually there's a big difference because you're getting a lot less income for property and therefore a lot more capital growth. And the benefit of that is you don't pay tax every year on the capital growth. You only pay tax every year of the income. So there's a lot more returns that are being reinvested and compounding. And so I just want to say quickly, though, that I'm not saying that property is better than shares. I mean, in fact, I believe in a diversified approach, but it's really about choosing the right club for the right shot. So, in golf, we're not going to tee off with a putter because we'll look like an idiot and it'll take a lot of shots to get to the green.
Sounds like me.
and me too. But it's really choosing the right asset for the right job. You will need shares. Probably you will need shares at some point, particularly as you transition, as you get closer to retirement. Shares start to become a little bit better than property, but that's okay. So you really got to understand where you are in your life cycle in terms of investment. If you've got a low asset base, your first goal is to build that asset base, and property, in my mind, is the best asset to do that.
Now, similarly, if you're comparing high growth properties in investment grade properties and, as you said a moment ago, blue chip areas, and maybe more cash flow positive properties in what I'd call secondary areas, it's the same equation. You'll probably end up overall with capital growth and renters much the same, but it's not the same in your pocket because you're not getting the capital growth, which is tax-free. You're getting the rent, which you're taxed on. And over the years, the rent goes up, as we said earlier on in the show, proportionately to the capital growth. So over time, in fact, the rent from that high growth property will supersede the rental in the poorer growth property. So selecting your assets is very important, asset base first. But I think one of your strategies also with your careful accounting and financial background is that you've got to be aware of risks. You actually want to maximize your returns, but not at any cost.
Yeah, that's right. And just
so that was one of your rules, by the way, too. You had a whole lot of great rules in Investopoly. I'm sorry, I actually probably bastardized the wording of it, but I think I got the message right.
No, spot on. Asset allocation's a really important thing because, we can't predict what markets will do, and we can't control what markets will do. And I think once you make friends with that, it reduces a lot of anxiety around investing. So I'm sitting here today and I don't know what the Australian share market will do. I don't know what the international markets will do. I don't know what the Australian property market will do, and so forth. So I don't know what will happen over the next 12 months. So the only thing I can do is really have a finger in each pie, is have a diversified approach and invest in assets that are negatively correlated, which means that if one goes up, the other one goes down. Because if I put all my eggs in one basket, and that asset goes down, my whole portfolio goes down. Whereas if I'm a bit diversified and I'm hedging my bets, then I'm going to win on some and lose on others, and I smooth the return out. And ultimately, it's proven, it's demonstrated that that's what's really going to determine my returns. So we can't control markets. What we can control is where we invest our monies. And so arguably that's an investor's most important decision. How much money do I put in super? How is that invested? How much money do I put in direct property? And how is that invested? So it's a really, really important decision.
And knowing that you can only probably own 3, 4, 5 properties in your lifetime because finance is getting harder, it's really important to own the best assets. And if you can't buy, in my mind, an investment grade property, sometimes the right thing to do is nothing. Just wait till you've got enough money. And that's one of your rules as well from the book Investopoly.
And I would caution people from thinking about their strategy in numbers of property. Think in terms of the amount of equity. So how much equity do I want by the time I get to 60 or whatever your target age is? And think of the number rather than the number of properties. So I want $4 million of equity. Okay, that's great. Now you can get $4 million of equity in a property by holding one fantastic property, right? So you don't have to necessarily think I've got to buy a massive portfolio. If you can, that's great, and you should do that. But it's really quality trumps quantity every day of the week. And that's what my more recent analysis has demonstrated. And really, this is not my opinion. The benefit of looking at this sort of analysis is it's just simple maths. You don't have to trust that Stuart Wemyss knows that he's talking about, or Michael Yardney. It's just here's the maths and here's the variables, and so we can prove it to you, an evidence-based strategy that really it's the quality of the asset that makes the most important thing. So, and that's another thing I've been witnessing, Michael, is that because of the contraction of borrowing capacity, people are starting to compromise on asset selection. And if you can't afford to invest in a good quality property, don't invest. But by the same token, the other thing with contraction of borrowing capacity, if you're of a mind to say, okay, I want to go and buy 2 properties, but because of my borrowing capacity, I can afford 2 assets at say 550. I would, holding everything equal, I would probably prefer to see clients invest in a $1.1 million asset rather than 2 assets for 550. And I'll be interested in your opinion, Michael, because it's likely you're going to get a much better asset at 1.1 million than the 2 individual assets, even though you get some diversification going 2 assets and a little bit more flexibility. At the end of the day, it just comes down to quality.
Stuart, I agree with you. In fact, only recently I had that conversation with somebody where they had a substantial budget and they were looking at buying one in Melbourne and one property in Brisbane. But rather than buy 2 secondary properties, I fully agree it would be much better buying one good investment grade property. Yeah, I like the concept of diversification, but when you start investing, property is lumpy. You can't diversify too easily. And diversification, as Warren Buffett would say, leads to averageness, and it's for people who can't really choose assets correctly. So I'd rather have all my eggs in the one basket and watch that basket very carefully. So fully agree with you that if all your budget is $550, well, then buy the best property you can. And there's some actually great house and land in the 7K ring in Brisbane at that sort of price bracket. You're out of the Sydney market. You're probably about 5 years too late. And there are still some apartments. You just got to be really, really careful with the right apartments in Melbourne in that price bracket, Stuart.
Yep.
So, Stuart, thank you so much. The bottom line is correct asset selection, play the long game, have enough cash flow to see you through, and don't be disrupted by all the noise, because in 10 years' time, in 5 years' time, it's not really going to matter, is it, Stuart?
No, it's not. And so if you just focus on the one factor, getting the right property, you need to then think about what are all the things you can do to get that right. And in my opinion, it's go out and get some expert advice. We don't buy property. Most of us don't buy property every single day. We don't have the skills. Now, you can probably acquire the skills if you really dedicate a lot of time reading and analysing and so forth. But the big missing thing is the experience. And the experience tells us how to apply those skills. So I've been a financial advisor for 17 years running my business. I've seen a lot of it, the good and the bad, the ugly. And I learned a lot more through experience, 100 times more through experience than I have by any studies that I've done. And I've studied way more than any human should ever study, I suspect. So really what you want to do is lean on someone with an extensive level of experience in order to get that asset selection right. So obviously finding a great buyer's agent that you can trust that's going to do that work for you, in my mind, is the simplest, easy, and arguably the most important thing you need to do to get that asset selection right.
Well, you can learn so much from the internet. You can do so much research. What you said a moment ago is right. You can't get the experience. And the other is the perspective that you have from being on the ground. And our buyers agents are all experienced selling agents. So they've worked in those patches as well. Now, Stuart, I'm going to put you on the spot because we've pinched some of your great ideas from the book Investopoly. Last year, you gave listeners to my podcast a special discount bonus if they mentioned the podcast. Can I put the same link in as we did last year to they're going to go to your show notes, to my show notes and see your great blog, but also ability to get the book Investopoly at a special price.
Absolutely. If they use the code Yardney, they'll get a 30% discount. More than happy to do that. The more people that read Investopoly, the whole point of writing a book, as you know, Michael, of course, it will generate a bit of business for you, but an unsuccessful book will do that just as well. So it's not really about building business, and it's certainly not about selling books and making money. You're not going to make money off
There's nothing
books.
in that, no.
It's so the only reason I laboured over this book is to really get the information out and spread the word, and really try and set a whole bunch of rules to help people follow, to really make sense of building wealth and developing a strategy and so forth. So the more people that read it, the better. So certainly I'd really love people to go and buy a copy, and then if they enjoy it, please share it.
Fantastic, because I think we're both going down the same road. We're wanting to prevent people making the mistakes that so many uneducated investors make, because there's so many mixed messages from people who've got a vested interest. Thank you so much for your time. The details of all this will be in your show notes. So if you're listening on a phone, just flip up and you'll actually be able to see the show notes and click on the links. If you're listening on your computer, well, that'll be really easy to do. Look forward to chatting with you again real soon. Thank you for your research.
Thanks, Michael. It's been wonderful.
Well, wasn't that a special episode? I think that's going to go down as one of the epic episodes of my show for 2019. So I highly recommend you listen to it a second time, because there was so much gold there. And if you did enjoy it, please tell somebody else about it. Just like Stuart and I both want to help more investors avoid the mistakes that are there and allow them to get the financial freedom they deserve. Help me by passing the message on. Tell somebody else about this podcast if you got some benefit. And of course, you can subscribe to my daily property update newsletter and get all Australia's leading experts giving you their thoughts and opinions. As always, I'd like to read out a couple of reviews I received. And if you leave me a review and I read it out, I'd love to say thank you by gifting you one of my books. When you hear your review called out, please email me at michael@metropole.com.au, and I look forward to gifting you any one of my books. Now, this time Sean said, Michael, I've listened to all your podcasts twice across various platforms over 2018. That's how informative and educational I find them as a beginner getting ready to enter the market. They make my Melbourne traffic and my commute to work bearable, so I thank you. So thank you so much, Sean. There was also one from Rowan, which said, Michael's mindset advice will help you change the way you think, leading to getting in the right headspace for wealth creation. It's interesting how my mindset moments are so commonly reviewed and highly sought after, and I enjoy delivering those. Just like the next review I got, which said, Rich Habits, Poor Habits. I listen to Michael's podcast on my daily commute to work, but I have to say I love the book Rich Habits, Poor Habits. I asked for this book from my kids for my birthday, and I enjoyed reading every page. I've highlighted all my favourite sections, made margin notes, and even transferred memorable phrases into my paper-based planner diary. I even have post-it notes scattered throughout. What I really like is hearing both Michael and Tom having their chats. You come across as just a pair of mates having a good old chinwag, but what you talk about is not frivolous. They are gems of wisdom and great advice. I'm at wealth level 1, striving to reach wealth level 2, but afraid that I've left my run too late. However, at least I'm on the journey. So congratulations being on the journey. Now, I'm sorry I don't know your name, but it's K8TTY2017. So thank you for leaving the review, and what I look forward to is sending you a copy of one of my other books. And for the rest of you, I look forward to having a chat with you again, this time next week.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from today's show, we'd really appreciate it if you would leave a review, and we'll read it out on a future show, and Michael will gift you one of his books as a way of saying thank you. Just go to michaelyardneypodcast.com/review and let us know what you think. If you don't already subscribe, head over to iTunes or your favourite Android app. You'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 30 minutes.